I would now like to call up Karen Gilmore from the Fed. As you know, she's Vice President, the Regional Executive for the Miami branch of the Federal Reserve. She's responsible for the Miami's community and economic development outreach activities and reporting back to the Federal Reserve Board of Governors. Formerly a city national banker, but fortunately has been fully reformed almost. But most importantly, a long-term Miamian and someone I consider a personal friend, Karen Gilmore.
Well, thank you. I thank Jeremy for always asking me to visit with you. They've given me a clicker, so this is going to work good. As you know, I visited with you every year about this time. I have to do this disclaimer that says that I am not officially speaking on behalf of the Federal Reserve Bank of Atlanta or the Federal Reserve System. You guys could probably, after several years now, you probably could read that for me, but I officially have to do that. So when we met last year at this time, 2018 was a really pretty good year. And during 2018, we had raised interest rates 3 times. We took advantage of a robust economy, a good job market, stable inflation. And so the goal was to start raising interest rates to a more normalized environment. So we left here. We had the last policy meeting of the year, December, and we raised rates again for the 4th time. So we ended up with short-term rates in the range of 2.25% to 2.5%. So I want to go back to that last policy meeting, given the events of this year. And as we all know, you're in real estate, so where interest rates are and where they're going is incredibly important to you, given the fact that it affects the flow of credit and capital, the valuations on the properties, and then ultimately demand. So I'm a big fan of the dot plot. I think I might have used it last year. Well, it's become really pretty important this year. So the dot plot, for those of you who are not familiar, is something that the Federal Reserve puts out every quarter. And it is in one spot kind of the thinking and the position of all of the policymakers. So there's 17 dots on there. And as you can see by the first column closest to me, this was the dot plot after the last policy meeting, that 2.25% to 2.5%. And if you look at the far column, that's sort of the long run rate. That is where policymakers think is the optimal rate for the U.S. economy, where they don't have to be too accommodative or too restrictive in terms of rate setting. And as you could see, that is higher than we're leaving 2018 and more in the range of 2.75 to 3% for most of the policymakers. And so you look at that and you look at the second column closest to me, which is this year, 2019, at the end of December. Well, they saw interest rates also higher than they were leaving them in 2018. So the translation for all of that is we could expect rate hikes in 2019. Well, I want to fast forward to June. For 6 months, we kept rates flat. So in spite of the fact that we were given this forecast in June of the probability of increasing interest rates, we held interest rates flat. And so, again, if you look at the first column, now this is where policymakers think we're going to end in 2019. And all of a sudden, you see a real divergence in what policymakers are thinking. And if you go to that last column, that long run rate, again, where they might be raising rates too, you can see, well, yeah, it moved a little, but it really didn't move that much. So I'm going to look at these a little closer so that you can really get kind of a flavor for what's going on here, because this is quite a change in the anticipated path of interest rate policy. So again, looking at this year, you can see that by June, policymakers half of them have shifted their thinking, and now they see interest rates by the end of this year in the range of 175 to 225 versus that 275 or higher, 3%, that they had thought 6 months ago. If you look at that longer run rate, again, you can see it shifted a little. It's down to about 2.5%, but not a significant move. So what this is saying is that policymakers are concerned about the current environment, the current conditions. So after we left here in December, went to June, now after June, the next policy meeting, which took place August 1st, the policymakers made their first cut. So that divergence in policymakers, where half of them were on a hold and half of them were on a cut, well, I guess the guys who were on the cut obviously won. And it's not a battle, okay? But there's voting rights. And so the 5 governors all voted for rate cuts. And so the policymakers that were more in a hold position tended to be the bank presidents. So you have this split in how the committee is looking at interest rates. So after that August, that first cut, they continue to cut interest rates for the next 2 meetings. So now the overnight interest rate is at 1.5 to 175, which is significantly different than last December, and even lower than they were forecasting in June. If you were to look at the September dot plot, again, you would see that that long run rate, where they want to raise interest rates to, or where they think interest rates are optimal, really hasn't changed all that much. So there's this shift in thinking around the current conditions. But the interesting part for those of us who are in the 4 walls of the Federal Reserve is this is the first time in a decade that you've seen policymakers split in their perspective. And this is the first time that you're really seeing dissenting votes among the FOMC members. So as my boss likes to say, policymaking just got a lot harder. So what happened? Well, we always say we're data dependent. We just kind of never say which data we're dependent on. So if you're a policymaker that's been in this hold kind of position, you're probably looking and leaning into data around the fundamentals. You're probably thinking, you know, the economy's pretty good. We've got, We've got strong unemployment numbers. We're in a 3.5 to 3.6 environment, lowest in 50 years, and we've been consistently in that environment for a little while. Even marginal workers, there's less availability of marginal workers, so people are being absorbed into the job market. We have a little labor force participation growth. So this is a really good-looking job market. We've been adding jobs. We were adding jobs at about 250,000 net new jobs a month for quite some time. That's backed off a little, but you would expect it to back off when you're in a low unemployment environment of 3.5 to 3.6%. You'd expect that pace to moderate. Last month, we added 128,000 net new jobs. At this pace, it is still more than adequate to keep us in this low unemployment rate environment. So the pace of net new job growth is pretty solid. Wage growth, while modest, has been in the 3.5, 3.6% range. So again, not overwhelming. It's a little lackluster. We thought there'd be a lot more wage pressure on employers given the unemployment rate, but it's still modest wage growth. If you were looking at our other mandate, if that's the data, you're looking at it, you're saying, well, inflation, okay, we're responsible for inflation, we set a 2% target, and if you're a policymaker, depending on how you think about inflation, you either think we're pretty much on target or within this range of about 1.5 to 2%. A little slightly weaker than we want since we were shooting for this 2% target, but this is probably not a huge concern for you right now. You'd be looking at economic growth. GDP last year was 2.9%, the strongest that it has been in a decade. The three red bars that you see on this slide are the quarters for this year. Q1 in particular was very strong, which is very unusual for Q1. Q1 is generally one of the weaker quarters. We did pull back a little in terms of growth, the second and third quarters. One of the things that happened in 2018 was the Tax Cut and Jobs Act, so it added some stimulus. Most economists didn't think that that was going to be sustainable. So you're seeing probably a little settling out of that. So there's been a little bit of a weakening in economic growth. But if you look at the green bar, we still think that GDP is going to come in someplace around 2.4% this year. What's driving that GDP number is the consumer. The consumer is very happy. They all have jobs. They're getting some modest wage growth. And so the consumer has been the backbone of this economic growth. So for policymakers who are supporting a hold, as I said, you're looking at this thinking maybe we should do no harm. But if you're the policymakers supporting the cuts that took place, if you're in support of those, you're taking you're taking a broader look at this, and you're saying, look, there's some risk out there. There are some headwinds out there. They're going to have implications for the economy, and we should be preemptive. We should get in front of them. And so, therefore, these rate cuts will continue to sustain the recovery in light of these risks. So you're looking at business fixed investment weakened this year. As you can see, the bars are now below the line. So we've had weaker business fixed investment. Well, few things could be driving that. The trade and tariff situation that began in 2018, accelerated in 2019. There's not resolution for several of those trade treaties. For business, they've been incredibly resilient during this period, adjusting supply chains, cost approach, tariff mitigation opportunities. But if you're a policymaker and you're looking at these trade and tariff issues, if they're persistent, they're going to eventually have deeper implications into the economy. Also, because of the tax incentive, we did see a pull forward of business fixed investment into 2018. That might have happened in 2019. And so you're kind of looking at business sitting on the sidelines while they absorb those investments. If you look at some of the business surveys, you'll see that business sentiment is a little softer. And so you're taking this on board. You're also looking at global growth. Global growth in China and Europe has weakened. These are big trading partners. The IMF has reduced or downgraded global growth to 3%. So you're considering this. There's other geopolitical and other financial issues out there. Brexit seems to be interminable. It keeps on going. So there's no resolution there. And so you're taking in as a risk the potential spillover effect of these kinds of things into the U.S. economy. Also, you're looking at your rate setting. So I could have used the New York Fed. They have a much more professional looking picture of how central bank rates are, but we chose to kind of modify that to show that our rate hikes last year really took us out of proportion to the other central banks around the world. And as you can see, when we started our rate cuts, I think it shows you that we're more closer in alignment. And so policymakers are looking at that because, as you know, this caused a flight to safety. We had much higher rates, big inflows of capital. So the question is were we too aggressive in 2018 relative to global central banks? With that demand, as I said, we saw a big inflow of investment money, put a lot of pressure on the 10-year treasuries, and we saw an inversion of the yield curve. That has sort of reversed itself, given the fact that we did the rate cuts. The spread is still pretty thin, but the yield curve isn't inverted at the current time. So these are the kinds of risk that if you're a policymaker and you're taking these on board and you may have been supporting these rate cuts. So what do we anticipate for 2020? Well, we anticipate that the unemployment environment will be very similar to what it is this year. Employment will, the labor markets will continue to be tight. We estimate that GDP in 2020 will be someplace in the range of 2%, a little softer than this year, but slightly above what our long-run rate is for the U.S. economy, which is 1.9%. So we're expecting a fairly good year next year. So there's a lot going on. So we talked about this divergence in the path of policy around interest rates. Chairman Powell, in his most recent press conference following the last rate cut, try to set market expectations that now we would be in a pause, that we would provide time to allow the rate cuts that we made to settle in and see how they affect the economy. And so he has set these expectations, and he's also indicated that we think 2020 will be a year of moderate growth, a strong job market, and stable inflation. If there's a couple of things that I would tell you to be on the lookout for next year, we think that the headwinds are pretty much the same. We have added the fact that next year is an election year. Those are always fun years. They tend to have some influence on sentiment. And if there's the two things that I would say that we're looking at and you should kind of keep an eye on, it's the consumer. So any change in consumer sentiment that affects behavior will be very important because, as I mentioned, they are really a driver behind GDP growth. and any change in business sentiment that influences businesses' approach to their employment patterns. So with that, we're forecasting another pretty good year next year. So that's it. That's what I have to say.